Focus. Ideate. Innovate. Enable.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to the Mutual Fund Day Family Financial Plan series, a show that puts the spotlight on investors from across India whose lives have changed thanks to right financial planning. Each episode, we feature a different couple with a differentiated financial profile. For this episode, we are featuring Aditya and Amrita Shah from Ahmedabad. Let's take a quick look at their journey towards financial security.
On this episode of Mutual Fund Day Financial Plan series, we explore Mr. Aditya Shah's financial planning journey. Mr. Shah, a resident of Ahmedabad, works at a higher management level with a multinational conglomerate. Mr. Shah's family includes his wife Amrita Shah, who was an investment banker in the US and is a homemaker now, and their two children, Arjun and Arav.
It started when when I was in the US. I was working at that time. We started investing a little bit in the equity markets and in mutual funds. I started, and also in the US, there's something called the a retirement corpus called the 401k, which we used to participate in. Through that, also we invested a little bit. So we learned, I learned the basics there. On my own largely at that time. Then but when we went to college there, we had to liquidate a lot of investments to pay for education, whatever we could. Again, so then we restarted again after graduate school. And then when we came back to India, we've been focused on investing, through the help of an independent financial advisor, Wealth First, and Mr. Ashish Bhai. And we focused on a mix of equity and fixed income products. On the equity side, mutual funds mainly, and a little bit of direct equity, and some portfolio management services. And on the fixed income side, it's been mainly tax-free bonds and some gilt funds.
We started investing in mutual funds ever since we started investing, I would say. So our primary first major goal in our life was, when we started our family, was to save for our children, and so we immediately put money aside for their education, and we invested that in mutual funds. And I mean, obviously there are the mutual fund industry or the financial industry always has cycles, and there are obviously ups and downs, but in the long run, when you have long-term goals, it always works in your favor to remain into the mutual funds, invested into mutual funds.
Mr. and Mrs. Shah started their investment journey at the start of their career. Today, 45% of their investments are in equity, 45% in tax-free bonds and gilt funds, and 10% of the income is allocated for savings and liquid assets.
So one of the main primary financial goals in the long term is to provide for our children's education, and we have worked on the assumption that they would want to study abroad at that time and for their college education, and so we've planned a corpus accordingly, and we've invested it in mutual funds, so that based on the assumption of a certain growth in value, it should meet their requirements. So that is one of the main long-term plannings we have done. Other than that, now we are focused on building an adequate corpus for ourselves for our retirement, which is many years down the line, but we're starting to plan for that now.
So I guess one of our goals is to make sure we provide for their college education, but ideally speaking, we would like them to be financially independent right after that, and not rely on us or anyone else for their once they have finished their education. They should be financially independent. So that is one of our goals in terms of education and awareness for our children.
We usually plan a couple of vacations a year, and we say plan for those in advance. Other than that, there are no in the immediate horizon, because we've purchased our main residence and kind of redone, the interiors and all recently. So we don't have any other major upcoming short-term expense as such, aside from the routine annual expenses that take place. So we are not, we don't have anything major on the horizon aside from vacations, if you will.
So the main short-term goals are, the day-to-day annual expenses for running the house, etc., and vacations mainly.
With efficient financial planning, Mr. and Mrs. Shah look at mutual funds as an instrument to achieve their long-term and short-term goals and to grow their wealth.
Right, that was the investment story of Aditya and Amrita Shah from Ahmedabad. We'll take a short break right now. When we return, a deep dive on their investment and goals. And of course, we'll be joined by Ashish Shah, an independent financial advisor, to provide his expert analysis. Stay tuned.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to the Mutual Fund Day Family Financial Plan series. In the previous segment, we understood the financial plan of Aditya and Amrita Shah from Ahmedabad. In this segment, we'll take a deep dive to learn more about their investments and goals. And of course, we are also joined by Ashish Shah, an independent financial planner, to get his expert insight on their financial plan. Let's start with the journey that both of you have had. Spent 14 years in the US. You came back after the Lehman crisis. Aditya, what was going through your mind when you were starting on your financial planning journey?
We were fortunate to, have worked in the US for a long time and, become independent in some respect in that manner. And when we came back, at that time, obviously it was in the economic world, time of a lot of uncertainty and apprehension. And we were also, in the same boat, like many people. But we got together and we decided to make a long-term financial plan for ourselves with the goal of achieving financial independence by we didn't have a particular age in mind, but before we become very old, so to speak, and we were still also going to pursue active professional, so income would continue, but we wanted to invest wisely to create a long-term corpus for ourselves. And we've developed a mix of fixed income and equity oriented and asset allocation strategy. We took into account both. We actively stayed away from real estate as an investment option. We were focused on real estate for our utility and for our use, but not as an investment. And so all our investment is primarily in fixed income and equities, and within equities it's mainly in mutual funds, aside from a few direct stocks. So that's, and we are it's a constant evolving process.
Okay, it is indeed. And Amrita, when you guys were arriving at a sort of a financial plan, what were your inputs into what should be the right allocation, so to say?
So our focus was mainly to have a good mix of equity and fixed income allocation in our portfolios. Also, we had started a family at that point, so we knew that we wanted to have a good corpus for our children when they grow up. So we did start planning for that immediately.
Get everything taken care of through your investments. Okay, Ashish, how has their portfolio changed from where it started to where it is now? Take us through that journey. Where did it start to where it is currently?
I think when we first met, we apprised about what are the investment avenues traditional in India, because they are coming after Aditya 14 years staying in USA, and Amrita almost 10 years. So we acquainted about there are 4 or 5 asset classes like gold, real estate and financial assets. Obviously, as he narrated, we zeroed into more or less on financial assets for the investment purpose. House, whatever convenience they have, they were searching for a house and they got the good house. Now in financial assets, I was of the opinion you should go almost on the equity 100%. Let us be honestly speaking, that was my first reaction to them, because they are in 30s, early 30s, just having a kid, and continuous current income, reasonable saving being in US. We started with a very large fixed income, honestly. But as every 3 months, 6 months, whenever we meet, intentionally we reduce fixed income, and I think today we are 45, and 10.
I noticed that they have investments in gilt funds as well. Now, people would wonder, what's the ideal time frame for investing in, say, a gilt fund, and looking into returns and tax implications and stuff like that? What do you think on that point?
I agree. In a fixed income, see, most of the money is in tax-free bonds, because it was a real core. If anybody in India, investor, wants a core fixed income investment, more than 2 to 3 years of horizon, I think government tax-free bond is the best solution. That is as per my advice, and a lot of investors are in tax-free bonds. For certain money, we want to have a little bit flavor, just to get some extra return. We plan for gilt fund to take the duration benefit. No doubt tax-free bond gives you duration benefit, there is no question about it. But 3 to 4 year horizon is bare minimum for any gilt fund investment, because of the tax efficiency, as well as gilt market plays very funny in India. There are hardly one opportunity in 3 years, and the art of exit is most important in gilt fund. But that's why we are very small portion we are putting into gilt fund, just to give a flavor, honestly speaking.
Was one of the objectives, Aditya, also to generate a sort of a third regular income for you, where you say all your investments generate enough of a pool of money where every month you have a third stream of income coming as well?
Yeah, I think that was also one of the objectives, and the idea is, because we do end up generating more income than we spend actually, so whatever extra we generate, we reinvest back into equities. So that's how our while keeping the principal in the fixed income intact, we've been able to kind of grow the value of the equity side of the portfolio by reinvesting the coupons, or reinvesting the whatever income flow we receive back into equities on a regular basis. So that also helps us time, kind of get an average of the timing of the market. We don't have to kind of do lump sums. We do it in a regular manner over a period of time.
All right. And do you believe that time in the market always beats timing the market when it comes to kind of managing the portfolio and making sure that it goes from strength to strength?
100%. This is my 25th year of my business. I believe the person who has just stayed in the market without any much, only those are the people who has made money out of the market. You have to be in market instead of timing the market. I think we are doing, most of the time we lose money by not being in the market. I think the biggest risk the investor carries in this country. I'll wait for that number, I wait for that day. It never happens.
How would you rate the performance of their portfolio so far, Ashish? As in terms of performance, any key data points that you could give for viewers to kind of understand how the right kind of financial planning helps someone build their wealth step by step?
First, I agree with you. First thing, they are very financially savvy, because he has worked in Wall Street also, and Amrita also was the ex-banker. That's why they knew the dynamics of the market. But another thing, as what just he said it, he was very prone to index fund when we decided to go for equity allocation because of the low expense ratios and all. Then it took me a very long time to convince him that India is still an undiscovered market, and paying a higher fees, not a fee is a constant, but you can really create the alpha. That was our first 1 or 2 years. It was a little bit, I had to always educate him about the non-index funds. And otherwise, see, then I told very clear, okay, what should be the objective when we really made a financial plan in the first or second, third meeting. Okay, what are expected return you should get from the debt allocation, and what are the expected return you should get from the equity allocation. I think most of the investors are not clear, okay, what is my objective return I should get. We always took the maximum. I want to double. No. I think, according to me, the fixed income allocation should give you inflation plus 1.5%. If it is after post-tax, you should feel happy. If you get 2% plus inflation and after tax, you have won the world. Obviously, if in today's context, if you get 6.5 to 7 post-tax, I think it's a fantastic fixed income allocation return. Equity, when I'm going for equity, the volatility is the only worry. Obviously, I should get GDP growth plus inflation plus 2 to 3%. I mean 50 to 16%. On base of that, only we did all these 45, 45, 25, this whole journey. But the base, any Excel worksheet is based on these two parameters. Okay, debt, you expect, previously it was 8.5 when we started, because we have a lot of 9% tax-free bonds also, that is for 20 years horizon. It is his luck and timing. I think timing in the fixed income market is more important than timing in the equity market. I can advise to the investors. Because to have a 9.01 NHB AAA bonds for 20 years is a gold, nothing beyond gold. That's why he is lucky to have that. Same way in equity, previously we were hoping 17-18% from mid cap and small cap. Now we have brought down to 15-16 accordingly. That's why this 45 equity will in the long run will go to around 70-75 within 1 to 2 years.
All right. On that note, we'll take a short break, but lots more points to discuss with the Shah family and of course Ashish here with us. Stay tuned. We'll be right back.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to the Mutual Fund Day Family Financial Plan series. We are following up on the financial journey of the Shah family from Ahmedabad, and also we have with us Ashish, who is the independent financial advisor who gives us his expert views on their financial journey. Now, Aditya, summarizing your investment approach, simplicity, that's what it's all about, isn't it?
Correct. See, we have always try to focus on products that we understand fully and that are clear and transparent. So many times we come across some fancy structured product which promises, on paper at least, a lot of high yields and high returns, and I'm sure some of them do deliver on that, but if we don't fully understand it, we try and stay away from it. So our investment basket, if you look at it, is very simple. It's essentially, we're on the equity side, it's large cap funds, mid cap funds and multi-cap funds and some direct stocks, and on the fixed income side it's tax-free bonds and some gilt funds and some liquid funds. So that's it. So it's not nothing beyond that, and nothing too exotic or esoteric that we...
Amrita, you have anything to add to that?
Yeah, so as we said, as Aditya said, we have always tried to stick to simple products that we totally can kind of work out how they are going to give us the returns. And so during demonetization and various other times, we were offered structured products which look very tempting on paper and promise us very high returns and also capital protection, but if we don't really believe, or if we don't really can work out how they are going to work on the back end, we try and avoid those products. And in hindsight, it has always turned out to be good that we have avoided those products, because during demonetization we got products which would offer good returns if the yields had fallen down further, but obviously that didn't happen, and so we are glad that we did not go down that path.
So what's the filter there for our average viewers when they are faced with these structured products? If you could summarize a few of the filters that they could employ to see whether they need to go for something or not, what would you suggest to them?
See, any product, when you go through the nomenclatures, because as far as SEBI is very active here, in a one pager you should be able to understand 95% of the product already first. That's the best product for you. You should not require, even any investor should not require more than 10 minutes to understand. Unless more than 10 minutes, there is some, this is a benchmark I am telling you. You should understand what exactly it wants to deliver and what is underlying. That's it. I think just sticking to 1 lakh ELSS for 20 years, people has made some 3 crore rupees. Any of the ELSS fund, let me do 2 crore to 3 crore rupees. This is nothing but a retirement fund. If this market is giving this much of return, you don't require to go for exotic product.
Now, avoiding debt has been also been one of the secrets of your success. Tell us how you managed to do that.
So I think we've avoided debt by avoiding temptation to consume kind of more fancy things, if you will. It is tempting many times, and you see that around you a lot. But we try and stay grounded and stay within ourselves, because I think, and especially when it is more applicable when we were younger as well, because avoiding debt enabled us to, we did have some necessary debt, like some for education purposes and even for residence purposes, but other than that we avoided any unnecessary form of debt. and we were able to therefore start our investing journey a little earlier, because we didn't, our savings didn't go into any debt servicing or debt repayment. So I think the idea is to live within your means, not desire things that are outside your means and especially purchase them. That's kind of one message I would like to convey to the younger generation of today, and not look to consume things beyond your means by borrowing money. So focus on that and start investing early. That will yield a lot of rewards in the long term, and once you are comfortable, then you can think about buying the things that you always wanted to.
And starting out for them, what's the right way to arrive at a plan for finances? For example, both of them are from a strong financial background, so therefore it was easier for them to arrive at the starting point of their journey and also trace their journey to where it is now. But for people who are not so strong in terms of, say, a financial understanding, what would you say is the right way to arrive at a plan for their finances?
The first is, we must be aware that there is no guarantee in India for pension type of. We should understand that. Before that, we had awareness at every moment that I am on my own or my family is on my own, financially I am taking. First, try to minimize the tax. You have to plan your taxation, because once money paid to government, it never comes back. That's why your tax planning, you should be very savvy. Now, first that you are required to save for it. Now, where you put that saving is most important. Then the role of advisor like me comes into the picture. As I said, person has put money into LIC or a fixed income for tax saving in a PPF. It is not a wrong product, but same guy has put money into equity-linked mutual fund. In last 20 years, instead of 55 lakhs, that corpus is 3 crore. The person at the age of 45 can really retire. If husband and wife have invested only 2 lakhs per year, saved the tax, and at the age of 45, they did that thing for 20 years, the corpus is 5 crore tax-free. You put at 6% tax-free. 30 lakhs is an annuity for life.
So better get in on the action quickly. That's the advice here, to have a comfortable retirement. And before we wrap up the show, what are some of the key learnings that you would like to share as a couple to other couples out there watching your financial journey? Tell them about some key learnings that you've had, which you would like to tell them.
One is, start investing as early as possible. I think that the magic of compounding will work to your advantage, and that is very difficult to estimate when you are young, but it's really a very powerful powerful mechanism which will help you, which you'll realize when you're older. And the second, obviously, avoid unnecessary debt is very important. Live within your means, and I think for younger people, obviously more equity investment is advisable, and that's something that one should start at as young age as possible.
All right, Amrita, your summary statement?
Yeah, and I would just like to add to it, keep when you are investing, keep things simple. Don't try and overshoot returns or your expectations. Try and keep them grounded and invest in simple products that you understand.
All right, on that note, we'll conclude this show. Thank you so much, everyone, for joining us. It's been a pleasure speaking with you. And that's a wrap on the Mutual Fund Day Family Financial Plan series. Tune in next month, where we'll have another couple and trace their financial journey. Thanks for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.